Welcome back. You're watching The Big Story. Well, the Income Tax Tribunal in the capital is likely to set up a special bench to decide on another issue of transfer pricing. The contention is above what limit should a foreign partner be compensated in an Indian company for the advertising and marketing costs incurred in India. Avantika now joins us with those details. Avantika, what's really the issue here?
That's right, Vivek. The ITAT is looking to set up a special bench to decide on a transfer pricing issue pertaining to the Brightline test on expenditure on AMP. Now, AMP stands for Advertising, Marketing and Promotional Activity. Now, this Brightline test essentially will decide up to what amount claims for deductions can be made on AMP costs incurred by Indian companies. Now, while royalty payments are being made, the contention is that by bearing the costs of AMP in India, the Indian entity is creating an asset for the foreign company. Basically, the foreign company is reaping benefits of the cost that the Indian entity is bearing. Therefore, the foreign company needs to compensate the Indian partner. Now, currently, the IT department allows deductions up to a limit for AMP costs as regular operational costs, but beyond that limit, deductions are disallowed. So, what is the upper limit for claiming deductions is the question that the bench will take a decision on, and we, of course, will be watching those developments very closely.
All right, let's also get in Sunil Lala, who joins me now from KPMG. Sunil, what would you make of the implications of what you've just heard?
Let me tell you the background on this matter. This Brightline test is something which was novel to Indian regulations. This concept started sometime back in 2002 in the US court in the case of DHL. In the case of DHL USA had incurred a lot of expenditure on AMP, and the allegation of the revenue was that some benefit of this expenditure has gone to DHL Hong Kong, and DHL Hong Kong must pay some royalty to DHL US. That's when the court decided in favor of DHL US and introduced the concept for the first time of the Brightline test. And they said it is very common for any licensee or any distributor to incur expenses on AMP. But once this expense crosses a particular limit, what they call the Brightline, and enters into the domain of what they call non-routine expenses, then probably the benefit of this may arise to the associated enterprise, and then a transfer pricing adjustment could be made. 8 years later, in 2010, this same principle was imported by the Indian TPO in the case of Maruti Suzuki. So we all know Maruti Suzuki is a joint venture between Maruti India and Suzuki Japan, and that's where the AU applied this Brightline test and made a disallowance. The Delhi High Court, in a way, though set aside the matter to the file of the TPO, which is the transfer pricing officer, gave certain observations which are supporting the Brightline test. When the matter went to Supreme Court, the Supreme Court said directed the TPO to pass the order in accordance with law, but ignored the observations of the Delhi High Court. So in a way, Delhi High Court, which spoke of Brightline, Supreme Court told the TPO ignore those observations. So there is clearly a controversy in this. The rules and
there is need for rules. This could be a good start.
I think so.
Actually have the appellate authority actually laying down rules.
I think
you're saying these rules don't exist.
They don't exist.
We're just going by one verdict.
Absolutely. So either we have more rules, or we have some OECD guidelines, or we have a special bench lay down the parameters, which they've done in the past in several other matters.
And this could, needless to say, have implications on most joint ventures in this country.
Most of them, more particularly in pharma companies and those dealing in consumer goods, because that's where really wherever a brand comes in, wherever the name comes in.
Okay. So you'll stay with us because there's another story that we're breaking here on The Big Story. Budget 2012, among other contentious amendments, also amended the law on taxation of royalties, and that too retrospectively. This move nullified the judgments with respect to the taxability of offshore supply of equipments. However, in an ongoing matter against Nokia Networks in the Delhi High Court, the government has clarified its position, stating that the amendments are clarificatory in nature. Isha has those crucial details coming up. Isha, tell us.
Yes, among the many amendments made retrospectively in the Finance Act, one relatively lesser known but with a major impact was the amendment made in the definition of royalty. Now, the amendment here said that a definition of royalty includes and has always included consideration for use a computer software. Now, in this ongoing case of DIT versus Nokia Networks, the contention has been with respect to payment for offshore supply of equipments, whether it includes including hardware or software, and whether such a payment can can come under income from royalty or not. Now, after the amendment has been made, government has come out, has clarified its stand with respect to the amendment. Government here says that the amendment that were made retrospectively are merely clarificatory in nature, and the definition, they did not make the amendment to expand the definition of royalty, because the definition of royalty under the Income Tax Act has always included the consideration for software payments. Now, with this clarification in its stand, it says that Nokia can be taxed by the income tax authorities. Now, among the major companies which this amendment will affect, it is going to affect the telecom network equipment suppliers like Nokia, Ericsson and Motorola. Now, earlier this year, Delhi High Court had ruled in favor of Ericsson, saying that such a payment cannot be termed as royalty and would not be taxed by income tax authorities. But with the government coming out with an amendment and clarifying its position, it seems that the government is set to tax these companies for such a payment.
All right, Isha, also joining me now on the show is Anish Mehta. Anish, tell me, you've just heard into this story. This is significant, the government's stand to say that this is clarificatory in nature. Could this have a bearing on other cases? We'll come to this one more specifically, but is there a larger message out here?
Yeah, I think it has a huge ramification. The government modified the section 916 and added two explanation 4 and explanation 5 with retrospective amendment from 1976. Now this is going to open up the entire Pandora's box, and look at that, the definition of computer software has been widened very large way. Now when a payment has been made outside India, assessee has a right to look at domestic tax or domestic law or a tax treaty. Now the domestic definition has been very widened, and you have got a treaties. Now in a treaty you got two types of treaty. One type of treaty which has defined a computer software like Malaysia, Morocco, Namibia, but the other treaties are very narrow in definition of royalty. And a UK treaty, you already have some precedent post the amendment in Income Tax Act in March. It still says that even the post amendment and retrospective amendment, the treaty still does not cover the definition under the royalty, the payment of computer software for a copyrighted article. So I believe that yes, government has changed the definition to widen the domestic law and cover the computer software, but treaty will still come to your rescue. However, one rider, government has also said that the term which is not defined under the domestic law in the treaty, they may define under the domestic law and then cover the meaning for treaty as well as domestic law. So I think we are in for big litigation again on this front, and a big litigation. The second connecting argument which is coming up from Ericsson's case, and post the Supreme Court judgment of Vodafone, whether the supply of equipment would be taxable in India or not. Now Vodafone judgment said that you have to apply a look at approach, not the look through approach. Relying upon that, some recent AR ruling which says that on a supply of equipment and installation services in India, assessee is not allowed to follow a dissecting approach. And if dissecting approach is not to be allowed to be followed, not only you have a challenge on a PE side and taxability of installation income, but also a taxability of supply of equipment. So I think the Nokia judgment is going to be very important. It's going to maybe one judgment will everybody look at, relying upon going forward.
All right, you really explained that well. Let's go on to the other big story that we have from the courtroom. A big boost for M&A activity. In a recent judgment, the Supreme Court has ordered that the amount that is paid as goodwill while acquiring a company will now be eligible for a tax depreciation. Avantika now joins us with more details on that. Avantika, what really is the Supreme Court saying?
That's right, Vivek. Now this order comes as a big relief for India Inc. Now the Supreme Court in its order has stated that goodwill is an asset that is eligible for a tax depreciation. Now let's understand what is goodwill. Now during the process of a merger or an acquisition, the purchasing company has to pay for the value of the assets as well as something known as goodwill, which essentially stands for the amount that is stand for intangible assets such as brand value, reputation of not the target company, etc. Now, in this specific case, before the Supreme Court, the Income Tax Department had denied the Kolkata-based SMIFS Securities a claim for depreciation on the amount that the company had paid towards goodwill, stating that goodwill is not an intangible asset. Now, the Supreme Court upheld the company's claim, stating that goodwill is an asset and depreciation can be claimed on it. Now, this provides a big boost for M&A activity, because in most mergers and acquisitions, companies pay a large sum for goodwill. Now, the incentive of a depreciation will certainly attract companies that are looking to buy. Now, another positive from the order is that it also puts some clarity on what assets come under the broad framework of intangible assets.
All right, Avantika. Sunil, you've heard that story. What really is the implications of this? Does it go beyond just this particular company's case? Have you seen a lot of other cases which could benefit from this?
This, as Avantika mentioned, this is a big boon to India Inc. If you see the history of goodwill right from 1922, from the inception of the Act, the law was contrary to what it is now, but fairly balanced. So if somebody sold his goodwill, there was no capital gains, and the one who acquired goodwill could not claim depreciation. This went on for about 65 years. 65 from 1922 to 1987. But it was contrary to this, but a balanced approach. Then in 87, goodwill on transfer became taxable. But nevertheless, for 10 years thereafter, the one who acquired the goodwill could not claim depreciation on it. So in that sense, there was an imbalance. The seller would pay tax on the goodwill, the purchaser could not claim depreciation. Then the law amended again in 98, wherein a provision was amended, section 32, which said intangible assets such as trademarks, know-how, patents, and business and commercial rights of a similar nature were eligible for depreciation. So the taxpayer would then argue that goodwill acquired was a business or commercial right of a similar nature. The department would take a contrary view. In fact, even in the last 15 years, there have been a number of tribunal decisions holding it against the taxpayer. In the light of this, this Supreme Court judgment is, much awaited and heartily welcomed.
All right, gentlemen, thank you very much, both of you, for joining us and sharing your perspective on those three very crucial orders which have wide ramifications as far as India Inc. is concerned. That's all the time we have for you on this edition of The Big Story. Thanks for watching.